A broker who had spent the first 2 decades of his professional career building a conventional Wall Street investment banking practice, who had watched the 1929 stock market crash destroy the savings of millions of American small investors who had bought stocks on margin during the preceding bull market, who had specifically warned his clients in 1928 and early 1929, publicly, in writing, before the crash, that the market was dangerously overvalued and that they should reduce their equity exposure, spent the following decade outside the brokerage business entirely before returning in 1940 with a specific and radical conviction that the fundamental reason ordinary American investors had been so catastrophically damaged by the 1929 crash was not that the stock market was inherently dangerous but that the specific way the brokerage industry was structured made it structurally hostile to the interests of the retail investors it was supposed to serve. His name was Charles Edward Merrill. Born in 1885 in Green Cove Springs, Florida, the son of a physician who supplemented his medical income by running a country store, Merrill had worked his way through college jobs and eventually entered the investment banking business in New York in the early years of the 20th century, building the firm that would eventually become Merrill Lynch through a series of partnerships and transactions before his specific decision to step back from day-to-day management in the 1930s. Morgan Housel has written that the specific reforms most likely to produce genuinely lasting change in established financial industries are rarely those imposed from outside by regulators who do not fully understand the specific mechanics of the industry they are reforming, but rather those driven by specific industry participants who understand those mechanics with unusual depth and who have concluded, through that specific understanding, that the industry's existing structure is damaging the specific customers it is supposed to serve. Merrill's specific 1940 return to brokerage was exactly this kind of reform, driven by someone with genuine industry expertise who had spent a decade thinking carefully about what the specific structural problems of the brokerage industry were and what specific changes would address them. The specific structural problems Merrill had identified in the conventional brokerage industry of his era were numerous and mutually reinforcing. Brokers were paid on commission, which meant their income was generated by transactions, which created a specific incentive to encourage clients to trade more frequently than was in the client's interest. Research was produced to generate trading ideas, which created a specific incentive to produce research that was more positive about securities than an objective assessment would have warranted. Accounts were available primarily to wealthy clients, because the specific economics of commission-based brokerage required high per-account transaction volume to be commercially viable. And the specific language of investment, the specific vocabulary, the specific analytical frameworks, the specific product structures, was deliberately obscure in ways that kept retail investors dependent on brokers for interpretation rather than capable of independently evaluating their own investments. Benjamin Graham's investment philosophy, which Merrill knew well and whose core principles he largely shared, emphasized that the specific structural alignment between the interests of financial intermediaries and the interests of the investors they served was the single most important institutional variable in determining whether ordinary investors could realistically build genuine long-term wealth through participation in equity markets. Merrill's specific 1940 reforms were designed precisely to address the specific misalignment Graham's framework identified. He introduced salaried compensation for brokers in place of pure commission, removing the specific transaction incentive that had driven the industry's most damaging practices. He insisted on plain language communication with clients, replacing the deliberate obscurity of conventional financial communication with specific, direct explanations of what securities were, how markets worked, and what the specific risks and potential rewards of particular investments actually were. Daniel Kahneman's research into how the specific framing and presentation of financial information affects the decisions ordinary investors make is directly relevant to understanding why Merrill's specific commitment to plain language investor communication was commercially significant rather than simply cosmetically different from conventional brokerage practice. Kahneman's work demonstrates that the specific way financial information is presented, the specific vocabulary used, the specific comparisons offered, the specific risk disclosures made or omitted, has measurable effects on the specific decisions investors make, independent of the underlying financial content of the information. Merrill's specific instruction to his brokers to communicate with clients in language that the client's wife or husband could understand was not a marketing preference. It was a specific recognition that the deliberate obscurity of conventional financial communication was itself a structural source of investor harm. Merrill also pioneered the specific practice of bringing brokerage offices to the specific communities where ordinary American investors lived rather than concentrating them in financial centers, opening offices in cities and towns across the United States whose local populations had historically had no practical access to stockbrokers at all. And he invested specifically in investor education, producing and distributing specific plain language materials explaining how stocks, bonds, and markets worked, at a time when the conventional wisdom of the brokerage industry held that educating clients was commercially unwise because educated clients would need brokers less rather than more. Robert Kiyosaki's core lesson about the specific importance of financial education, about the specific difference between people who understand how financial systems work and are therefore able to use them to build wealth, and people who do not understand those systems and are therefore systematically excluded from or exploited by them, applies to Merrill's specific investor education initiative in its most direct and literal form. Merrill's specific conviction that ordinary American investors would make better financial decisions, and therefore achieve better financial outcomes, if they understood clearly how markets worked and what they were actually investing in, was not a conventional industry belief. It was a specific, contrarian, and ultimately commercially validated hypothesis about the specific relationship between investor knowledge and investor behavior. Merrill Lynch grew, in the decades following Merrill's 1940 return, into the largest retail brokerage in the United States, a position built specifically on the specific demographic that the conventional brokerage industry had either explicitly excluded or structurally underserved, and on the specific trust that Merrill's founding commitment to transparency and plain language communication had built with the specific investors who experienced it. Here's an honest complication worth including. The Merrill Lynch that Charles Merrill founded and the Merrill Lynch that collapsed into near bankruptcy in 2008 and was acquired by Bank of America are connected by name and institutional lineage but diverged, over the decades between Merrill's death in 1956 and the financial crisis, in specific and important ways from the specific founding principles he had built the firm around. The specific financial products and risk-taking practices that brought Merrill Lynch to near collapse in 2008, including the specific accumulation of collateralized debt obligation exposure that generated billions of dollars of losses during the mortgage crisis, were not the product of the founding philosophy of transparent, client interest-aligned brokerage that Merrill had articulated in 1940. The institutional distance between the founding philosophy and the crisis-era practice is itself a specific instructive story about how founding commercial principles can be eroded over decades of institutional growth and competitive pressure. George S. Classen's fundamental advice about the specific importance of financial intermediaries whose interests are specifically aligned with the interests of the people they serve, rather than misaligned in ways that systematically benefit the intermediary at the client's expense, describes the specific reform Merrill attempted in 1940 with a precision that makes Classen's ancient Babylonian wisdom feel directly applicable to mid-20th century Wall Street. So here's a question worth sitting with. In your own current financial relationships, with brokers, advisors, banks, or any other financial intermediary, do you specifically understand how each of those intermediaries is compensated for the services they provide you, and whether that specific compensation structure creates incentives that are aligned with your interests or specifically contrary to them? Before you leave, I want to hear from you. Have you ever discovered that a specific financial product or service you were using was structured in a way that specifically benefited the institution providing it more than it benefited you? And did that discovery change how you approached your subsequent relationships with financial intermediaries? Read a few comments before you go. Some of the most practically important insights on this channel come from people who've answered that question from specific personal financial experience. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. Charles Merrill did not build the largest retail brokerage in the United States by being more skilled at selling financial products to the investors the conventional brokerage industry was already serving. He built it by concluding that the specific way the conventional brokerage industry was structured was systematically damaging the investors it was supposed to serve, and then building a specific alternative structure whose founding principle was that the brokerage's commercial success and the investor's financial success were not in fundamental tension but were, when properly aligned, specifically the same thing.